Good afternoon, ladies and gentlemen. This is Dina Abdel, an assistant professor of economics at the AUC School of Business. I hope you're all keeping well and staying safe during these testing times. It's an honor to welcome you all to the Willard Brown International Business Leadership webinar today, Building a Sustainable FinTech, featuring distinguished speaker Jonathan Liebenau, professor and reader in technology management at the London School of Economics, and an associate of the Columbia Institute for Teleinformation, Columbia University. He was educated in science and technology policy, the history and sociology of science, technology and medicine at the University of Rochester and the University of Pennsylvania, where he earned his PhD in 1981. Liebenau is the author or editor of 12 books and over 70 articles in information systems, innovation studies, telecommunication and internet policy, and economics, business history, and the history of technology. In today's session, Liebenau will address the ways in which new technology addresses the regulatory conflicts using the British cases which have inclusive experimentation in addressing market concerns. If you have any questions, please, during the session, please write them down in the Q&A box. Thank you all, and we hope you enjoy today's webinar. Professor Liebenau, the floor is all yours.
Thank you very much. Well, it's a great pleasure to be able to speak with you, and I hope that this talk will be of interest and that it'll take your mind off of COVID. We are so much concerned these days with COVID that we have lost track sometimes of the things that make life interesting for us or difficult, and the problems we need to address. So for the next hour at least, we'll have something of an alternative to COVID to think about. So the problem that I'm addressing is in particular to do with the relationship between the fintechs and the kind of problems that they create for us as we try to understand best the way forward, how to accommodate the technologies, how to exploit these technologies. And the problem is probably familiar to most of you. These new technologies prompt business model innovation, and there are many advantages, but certain disadvantages too. So the way I'm going to frame the problem for today addresses the way that these boundaries are being pushed and the way in which the technologies create problems through both the pressure on incumbents, but also on regulators, and by direct impact through regulators on policymakers. And it's incumbent on us to take these things into account, shall we say, at once. The key determinant of sustainable opportunities for fintech and for the continued legitimacy of regulators stems from reconciling the governance divergences that come about through the architecture of these technologies. And these architectures are not just efficient solutions to straightforward engineering problems. They accommodate institutional logics, the way in which people in the associated organizations think about things. And we've been studying this kind of institutional logic problem in relation to the architecture and technology problems in order to come up with solutions to a persistent problem that has been holding back both the opportunities for fintech companies, but in particular, the way in which the responsibilities of government and the financial services community more generally ought to be able to respond. So the timing of this is pertinent for many reasons, but I want to point out that Dean Sherif Kamel wrote about this very recently in his newsletter article. And so he gave a nice introduction to fintech more generally. He used this illustration. And I think that putting my talk into the context of his recent contribution is appropriate. I want you to look at the middle right side of this diagram to get a sense of the relationship between these symbols, which represent government and fiat currencies, and the regulatory responsibilities and the incumbent banks and other financial services institutions as we talk through these problems. So we can frame this problem in terms of the way in which emerging technologies address the particular immediate responsibilities that regulators have towards regulatory reporting. And we're watching now over the past, well, we could say 15 years, but accelerated in particular after the financial services crisis of 2007, 2008, we're watching these firms extend and redraw the financial services boundaries. And this has many advantages. In addition to ways of making money, it also lowers barriers to financial inclusion by reducing individual risks and entry costs. And I think that this is something I want you to keep in mind as I'm speaking. I won't be talking about this as a matter of a core issue. It's something that Dean Kamel wrote about in the newsletter piece that many of you will have read. But this is the great advantage which we really want to promote. It also reduces routine charges for the incumbents, and it does so for the businesses that they serve through competition, and it generates efficiency savings by automating functions which had been highly skilled manual activities. There are other advantages too. Since we're using more electronic money, the high cost of money handling is being reduced overall. And it also helps by reducing some kinds of bank operating costs, the anti-money laundering and know your customer. That's the abbreviations AML, KYC. These regulatory requirements that banks and other financial services institutions comply with in order to be able to participate in international financial services. So in order to even use SWIFT for international payments transfer data, you have to show that you're AML KYC compliant. So in general, we see a variety of advantages of fintech that from a policy point of view, we want to promote. From a business point of view, we want to exploit. From a customer's point of view, we want to see the advantages accrue to us as customers. Another element of these advantages is that because so much of these activities can be run by data and the data can be structured properly, it increases our opportunities for fiscal monitoring and various other kinds of controls. Now, these bring with us many disadvantages in addition. Fraud and accidental losses. There are thefts of certainly cryptocurrencies like Bitcoin have suffered great thefts. But other disadvantages that I think are even more important are distorted markets, sometimes through market manipulation, sometimes through practices which we hadn't anticipated but sort of creep up on us. And these bring about the real problem of systemic risk, that is the possibility that runs on currency or lack of trust in financial services organizations could cascade. And this is aggravated by the fact that regulation is really not ready to respond. Now, regulators ought to lag behind the market anyway. We can't expect regulators to be at the forefront. It would be a deterrent to innovation if they were. But we want them to be in a position to, first of all, ensure their roles to promote these advantages and act as custodians of national interest. And we also want them to be close to the technologies that are emerging because they can themselves benefit from it. And much of what I'm going to be talking about now addresses this relationship between the fintechs and their use of the new technologies and the regulators and the opportunities that they perceive to be able to be part of the solution. And so much of what I'm going to be talking about now is addressing these solutions so that it's not just the advantages to the companies that we want to talk about. We want to see what advantages, or at least reductions in disadvantages, we can find among the regulators. And the research that I'm reporting on is part of a portfolio of research activities that I've been involved in, which have looked both at the regulators in the UK and in a few other leading regulating organizations, like the Singapore regulator, the Australian regulators, and those in the United States, with some discussions at the EU level. So that's one level. And then I've done a few studies of business models in fintech companies. So looking at international comparisons, including in the MENA area, how the companies find niches, what kinds of technologies they're using. And so I have now about 4 papers and another couple underway. Excuse me, I have to get some water in a moment. But I'll talk about 2 things. One is the main regulatory practice in the UK is centered around digital regulatory reporting, and another, excuse me, I'm going to take a little break and ask for a glass of water. Just a moment.
I'm again reminding everyone to send your questions in the Q&A box. So Professor Liebenau is going to take a minute of break and then we're going to resume again. But I'm again encouraging everyone, if you have questions at this point, to please send it in the Q&A box so we can take them as we go on.
Okay, I'm back. Sorry.
Welcome back.
Thank you. Okay. So the research questions that have motivated me for this particular part of the work has been to do with how the way that we think in banks, in regulators, as customers, how this shapes the technical systems that we're trying to introduce. And on the other side, how the technical systems shape and force us to reconsider the way that we think about our business models, our roles, and the controls that we might be using. And we want to see what the consequences of this might be. Okay. In Britain now, we've had just over 4 years of experimentation. And I want to emphasize that this is experimentation. We've used a lot of controls on some of these experiments, and we've been analyzing them with iterative design considerations. And we put this in the context of a kind of arms race between firms and governments based on the technologies that they're using, but also based on shifting business models, different kinds of customers, different ways to extract value from these new fintech activities. And it comes in the background of the opportunities that machine readable forms of these data processing practices can be adopted by regulators. We have this legacy of massive data infrastructure designed for quarterly and monthly reporting, batch processing, cliff events, that's deadlines for filing reports. Otherwise, the whole system sort of lays idle. Of course, it's used for continuously collecting data, but not for reporting it. It's wasteful for the whole process, and it requires considerable redundancy in architecture. There are a lot of knock-on effects of this. Among them, I should say, for areas where the depth of the labor market is not great, there are skills problems associated with this kind of accumulated regulatory burden. And in 2015, the UK government decreed that RegTech was going to address fintech and these sets of problems. And it began a process which later became known as the DRR process. And I've studied a few of these activities, in particular the ones that a number of leading organizations listed here, the Financial Conduct Authority, that's the FCA, and the Bank of England, BOE, working in conjunction with leading banks, started to coordinate their activities, standardizing data gathering, becoming more adept at machine executable code, and trying to begin the process of taking the legal text, making it formalized so that as much as possible compliance could be done in real time. So these underlying technologies of machine learning to recognize malfeasance and other sorts of things were being tested already starting 3 years or so ago. And in the case of the Financial Conduct Authority in Britain, the scale of this is something close to 60,000, over 50,000 anyway, around 60,000 firms spending, actually most of them spend more than 1% of their operating costs on just routine reporting, and of course, responding to ad hoc requests of various kinds. So the features of this digital reporting include include processes that experimented with new kinds of data gathering processes. I'm particularly interested in the experiments that dealt with blockchain, the distributed ledger technologies. And 2 of these models were built, one for retail and one for wholesale activities, that is interbank activities, and for reaching out to public use of these kinds of data processing activities. I'll come to the key one that I've analyzed in a minute, which deals with mortgages. The point about this use of the blockchain is that it allows for a very interesting set of decentralization processes for the whole community. So instead of just concentrating data gathering and then data reporting, it allows for people to gather and report in their own time, but coordinated so that it's an always live process. And the advantage of blockchain is that it can be structured well to do this. It also resolves a number of certain kinds of identity problems and privacy problems. And in the context of Europe and those doing business with Europe, the General Directive on Privacy, the GDPR, concerns are always part of the design requirement. So there were a number of pilot projects. There was one which dealt with the loan to income compliance check. This is a standard sort of thing. In the case of mortgage loans, there's a requirement that no more than 15% of mortgage contracts exceed 4.5 times declared income of the borrower. This is the sort of requirement that is used to try to keep financial stability in the system. It's the sort of thing that happened to go out of control in the United States in the mid-2000s, leading in 2007 to the event which was the prelude to the collapse of the financial services system in 2007, 2008. which was a lack of rigor in enforcing loan-to-income compliance checks. That's at the core of the regulatory element of the financial services responsibilities. Another example is a compliance check on capital to equity ratio, and that again is something which is implicated in the financial services debacles of the mid-2000s, where the ratios got out of kilter, and it was felt that the banks were not retaining their assets well enough to be able to cover their debts. So the purpose of the models was to create compliance checks, and regulators then had to schedule their activities in a way that allowed them to do continuous monitoring. They needed to restructure their own staff activities in order to create this monitoring function. It's not necessarily a greater burden for them, but it's a different kind of monitoring activity. And the regulators needed to be able to deal with the process of taking data directly from the firms through the blockchain, using, in many cases, smart contracts that are embedded in the blockchain. The smart contract allows the relationship between the regulator and the regulated body to be formalized, and you can have conditions of contracts created so that, for example, if you exceed a limit and a penalty can be applied to that, say this 15% limit on the proportion of large loans. That's an example of that. If a penalty is going to be applied, the smart contract can automatically apply the penalty. And indeed, this can be easily extended so that a cryptocurrency embedded in the blockchain can be used as a method of payment. So you can do it all internally if you wish. So these kinds of tools were being experimented with. But there were a number of disappointments in the process. There were difficulties in scaling up. It was found that it was really, although people doing natural language programming make promises all the time, they recognize that these promises are hard to keep, but the natural language programming problem to make regulation operationable really still is a big issue. A lot of it's actually being done, and I'm optimistic about it, but I think we have to recognize that we're not going to be able to do 100% of this machine readable regulation, and we have to be clear where that cutoff point is. Maybe we can do 80%, but we need to know precisely where that 20% other is. But the real problems had to do with this restructuring and the governance implications associated with that restructuring. So I'll speak about the example that provides the best opportunity to analyze what this relationship was between the expectations and the delivery, and talk through it in a little bit of detail. I'll do so quickly so that we can have lots of time for discussion. Project MAISON, MAISON for houses in French. The idea is, of course, that we have a blockchain system that brings together all of the key organizations involved in lending. So the architecture was designed to link the borrowers and lenders, the regulators, and other kinds of institutions. These are very different kinds of institutions, however, of course, competing financial services institutions, consulting bodies that advise on mortgages and lending, government bodies, both the Financial Conduct Authority, which monitors the lending, but also the Bank of England, which has primary responsibility to ensure that something like the systemic risk that created the financial services debacle in the United States around 2007 won't occur again. So it became part then of the financial services information system, this Project MAISON blockchain, and it was intended to bring together then tax, land registry, Bank of England, and others. This diverse group of stakeholders were required to come together and resolve a number of conflicts, which they could then build into a smoothly working consensus design for how mortgage reporting is supposed to work. So here we have a situation where mortgages are a very large, but a very routine set of processes. The Financial Conduct Authority regulates over 13 million mortgages in Britain. Of course, it's much larger in the United States, but the scale of this experiment was appropriate, I think, in that it was large enough to capture the variety of activities and to be able to use big data analysis on a lot of the data that's generated, but small enough so that they could keep up with these kinds of activities and monitor the process as new mortgages were being introduced into the system. Mortgages, of course, are also rather top heavy in the cost of regulating and reporting. There's a lot of duplication in the process. This is partly because everybody recognizes that there are these risk elements to it. And even though the system is really not very complicated, it's very intricate. And this diagram describes some of this intricacy, which has first of all, a monthly reporting cycle and a quarterly reporting cycle. And it takes a considerable amount of time to clean data and report it. And then it takes time to consolidate the data and begin to analyze it, and then to come to the point where the feedback will be meaningful insofar as a system that might be getting out of control can be moderated as we go along. And there's lots of standard forms that this illustrates the intricacy of it. The blockchain may not look tremendously more simple, but it is, in fact. It's more simple in particular because, as you can see in the left side of this diagram, there's no real-time, there's no batch processing. It's all real-time reporting, or near real-time reporting, and this data can go to a variety of bodies: the land registry, the surveyor's office, the solicitor. You can imagine it can go to the municipality, the planning offices, the municipal architect, whoever has a need to know. And so the blockchain system coordinates the stakeholders into a single structured system, allowing customized access to information on a need-to-know basis, so that the regulator can see things that a bank might not want its competitors to see. Banks can keep records on there that might be necessary for the tax authorities, but not necessarily the regulator. Other such things can be designed into the system. And it addresses most of these kinds of problems about the cost and qualities of data. I won't go into all of these in detail, but I want to emphasize that the technology has the capacity to deal with problems about the qualities of data that are necessary and about the processing time and cost and the responsibilities within the various organizations for accommodating the information processing activities. There were three main use cases that were being tested in the system. One is this enabling of continuous reporting and allowing the new mortgages to be booked directly onto the distributed ledger technology. So the blockchain could contain the information as the mortgage was being approved. The second thing is it promotes competition by enabling switching. And this is important so that there will be an opportunity for customers to get out and refine or revise or eliminate the mortgage responsibilities that they've initially come into if their situation changes, or if the lender has a situation that changes. The third use case is the engagement of additional third parties of various kinds. So you saw from the diagram that the land registry, the surveyor's office, the tax authorities, one can imagine many others can be brought in, and we were experimenting with the expansion of this by writing rules that would accommodate them. And then we can design interfaces. The one on the left is a view from the bank of what their exposure to mortgages looks like, and then a modified view for the regulator, not containing commercially sensitive material. And so the interface on the right demonstrates the similar data, but presented in a way that's meaningful for the Financial Conduct Authority in this case. And the benefits are pretty clear, and they were seen in the experimentation. Everyone pretty much recognized that the customer experience was going to be improved, that there were considerable qualities of transparency, and which the regulator needed, of course, and data quality, and it reduced operational risk and cost to the banks in particular. But there were extraordinary problems which have meant that this system cannot yet be commercialized. And although there are a few experiments which are taking on from this, we really need to be able to resolve a set of governance problems which we analyze in terms of the contested logics. That's our terminology. It means that the way of thinking and the primary goals of the various organizations involved get exemplified in different ways. And these things are designed into the system in a manner that really needs to be accommodated before the system can be said to be working smoothly, so long as you have an assumption that all of the participants are taking advantage of the coordination functions to buy into the system and recognize their advantages that are coming out of it. So I'll have to go through these very quickly, but I want to emphasize 5 different kinds of alternative ways of thinking that different people bring to the problem. So I'll go through these briefly. The first is this notion of a reactive versus a proactive function. And here we can see that the role of the regulator changes when they're on top of the data. Instead of responding post hoc to problems that have emerged and might go wrong, the responsibility of the regulator is now to be on top of the unfolding financial activity and respond immediately. Now, this is actually a rather difficult problem to reconcile, even in regulatory theory, because the assumption is that the regulator is going to wait until there's a threat to the market that has been demonstrated by some kind of effect, a distortion in the market, illegal behavior by a monopolist or something like that. So to be more proactive in this way creates a different kind of conceptual role for the regulator, which was very difficult for everybody to come to terms with. The second area of contested logic we call calculative custodianship. This means that who owns the calculations, who's responsible for them, seems to be vested in the system itself. And in practice, in certainly legal practice and in the common practice of these institutions, this is very difficult to reconcile. So we have a quote from one of our informants who, when told that the lawyers would approve this system and the distribution of liability, said, "I disagree. Just because you're using a blockchain or you have a piece of code doesn't change corporate or regulatory accountability. It's not just about the data, it's about owning and being accountable for the calculations that run the data. We need to own the outcome of these calculations." And so this idea that you can make this an entirely technocratic system where the responsibilities are formalized in the technology is rejected in the experience that we had. Another problem was about who owns the infrastructure. This is actually something that wasn't greatly exemplified in the models so far, but it was noted that by using a proprietary software, requiring the blockchain to be designed in a single way does create a monopoly. There aren't opportunities for competition in infrastructure, and this was seen to be potentially a problem, and certainly people were worried about pricing power. The fourth had to do with the conflict between rules and principles of business practice. And this has to do with the opportunity for discretion to be applied. And a lot of people involved in the system were worried about the theft or misplacement of their agency, their own opportunity to act in their best interest when they wanted to deviate from the rules. So this comes from the requirement that the system be formalized at the outset. And the last of this list of contested logic has to do with the problem about discretion versus standardization. So this relates to the problem I addressed a moment ago in number 4. But here we can see that at the individual customer level, people wanted to be able to exercise discretion, even if at the aggregate level, they didn't feel that they needed that. But they didn't want to lose customers because they were no longer able to have the kind of personal relationship that is based on the discretion that they can demonstrate they have in the process. So these are the main lessons we learned from Project MAISON, that the distributed ledger technology, this blockchain, forces regulators and banks to reconsider their roles in a really profound way, and a way that we can analyze. It's not just an abstract notion that things are shifting and we need to, but we can analyze it. We can understand exactly where it fits into design elements, and we understand much better now how these can be recognized and responded to in some detail. And these tensions that we identified, we believe, are going to be persistent in highly regulated industries across the board, in healthcare and law and energy, pharmaceutical, you name it. We're going to find that. So in conclusion, I want to say that the implementation of this decentralized approach, taking the technology from the fintechs using it to enhance the relationship between the business models that the fintechs themselves use and the opportunities of the policymakers to retain their responsibility for ensuring both the economic benefits of these systems and their control over the systems that are necessary in order to fulfill their statutory requirements. Now, I'll leave you with two general comments that I think are in particular of concern for the MENA region. We could say that these are broad concerns, but the first one about promoting financial inclusion is something that, that the MENA region needs to take into account in particular. And Dean Sherif Kamel wrote about this in his newsletter piece recently. So this is a matter of not just getting into banks, but also systems like this, facilitated by fintechs, but legitimated by regulators, address issues that go well beyond just opening bank loans. They have to do opening bank accounts and getting loans, but they have to do with all kinds of other activities that we can begin to use the fintechs to exploit. And there's no single way to meet these goals, but if competition is to be fostered, then we have to recognize these as a system, and we need to look to systems solutions to these kinds of problems, as we do when we use blockchain or other kinds of large coordinating systems. The second is that these systems require governments to have new, but not necessarily more expensive skills. They need to rethink their roles, and they need to address the difference, for example, of monitoring and a real-time reporting system versus compiling a batch processed reporting system. And this addresses issues of competence, transparency, reach, and trustworthiness. These are great concerns that we have to monitor at all times ourselves. And the institutional logics that I addressed in the talk more generally are probably amplified and even more divergent in MENA. So a lot of effort has to be made to anticipate, to articulate, to design in, and as best as possible, resolve these before we can expect to earn the benefits from fintech. So I'll leave it at that, and I'll begin looking now at your Q&A and hope that our chair will also help me to work through these questions.
Thank you very much for the very interesting presentation. And as you said, we got very interesting follow-up questions in the Q&A. So let me start sharing them with you as we go on. First question was, will the cryptocurrencies sponsored by central banks ever take the glamour away from Bitcoins? And what is keeping central banks away from entering the market of cryptocurrencies? Would you like to take all the comments together, or would you like to
No, I one at a time. I'll get confused, and
Sure.
I can see that they're very different points.
Yeah.
So for the first part of the question, the answer is I hope so, because I don't trust Bitcoin, the volatility of the Bitcoin market, and the fact that many of the trading markets for cryptocurrencies are unreliable is a concern of mine. More than unreliable. I think that some of them are demonstrably fake, fake data. So I would hope so. The reason central banks might use cryptocurrencies, though, is not primarily to replace fiat currency as payment system. It would be to enact interbank payment processes so that they can do so without disturbing the fiscal balances that the central bank is responsible for maintaining. So instead of shifting currency, and often physical currency, from central banks to banks, I think a cryptocurrency process could be used. It's better than the transfer just of electronic currency. And I think that central banks will be entering cryptocurrencies. I think that there's already a few models that are worth pointing out. A bad one from Venezuela, where they had some kind of crazy idea that by making their currency crypto, that it would get more trust than the fiat currency that had lost trust, that had fallen into disrepute because of inflation and other things. So that was one. But there's a good example, models in the Bank of England for interbank payments and for other kinds of monitoring. And then there's examples like Ripple, which is a reputable payment, interbank payment company with a few other services. And they use blockchain and cryptocurrency for their interbank services. Essentially, that's taking fiat currency value in one place, in converting it into cryptocurrency, transporting it around for various kinds of payments, and then reconverting it to fiat currency. So it's an example of a good use of cryptocurrency to get the advantages of reliability and security and instantaneous payment without other kinds of volatility. So we can talk more about cryptocurrencies, but that's my general view. I'm not a fan of Bitcoin. I am a fan of the blockchain technologies that stand behind it.
Thank you very much. Another question was saying, the UN announces biometric digital ID wallet to their own employees starting from this year. If the whole financial services will be linked directly to our ID somewhere in the near future?
Possibly. I think that there's going to be a lot of pushback for this, and the pushback will come from a number of places. One place it'll come from is those who are concerned about the way in which China in particular uses surveillance, where they have actually, in a way that's absolutely straightforward and not deceptive at all, they simply said, we're going to link all kinds of data, social media, your purchasing data, your use of financial services, even your use of government services, including schools. What we fear about this kind of integration based on a completely unchangeable identity like the biometrics creates is that, let's put it this way, we need an unbounded trust in all aspects from top to very bottom of those who have any control over these. So in every aspect of government, and very few of us share that level of trust. The Chinese don't either, but they don't speak about it very much. The other pushback, though, comes from the way in which companies are going to be engaged in this activity. And do you really want whoever the top shareholders in Apple are to have primary call on your Apple Wallet and the biometrics that are associated with it? Even if we trust Apple not to misuse it in really nefarious ways, we might not like the fact that they'd be tempted to use it for competitive purposes and just supersede a Google wallet or a Deutsche Bank wallet. So I would not want to push this. I don't think I'm against it in principle. I'm against it in practice for all kinds of reasons. So I won't say it should never be done, but I can't imagine anything in the future that I can foresee that would justify it to me.
Another question concerning the blockchain and the EU GDPR. Majority say that there is a conflict between them, and some say there is no conflict. Are there any conflicts between them?
This is a design question, and it can be designed so that there is no conflict. I'm confident of that. You have to be careful about the design, and yes, I know that there are design solutions which can ensure that there's no conflict. It is true, though, that many such systems don't respect that. They're either poorly designed or they're regarded as having advantages in circumventing some elements of GDPR. So I think we need a way of assessing these design features to ensure that that doesn't happen.
Another one saying the financial sector is innovative since its inception, giving examples from the Fargo Travelers and checks, ATMs. What are and what discriminate the current 2 decades approximately hype of fintech from the previous financial innovations?
That's a very good point, and I agree with it entirely. There's something to be said about the change in fintech in the late 2000s after the financial services crisis, and that had a lot to do with the way that regulators allowed some doors to be opened, and the fact that a lot of clever people got fired from their failing banks and found nice entrepreneurial ways to build new teams and build new businesses. But you're absolutely right. Fintech, in its modern form, I would date from the 1950s when banks became the early consumers of mainframe computers and big processing. However, it is also the case that those pioneering banks using 1950s computers quickly became complacent. They were ahead of other sectors and didn't see a lot of pressure to change. The consequence of that is that you have these cycles of innovation. You could say that there was the initial computerization and digital cycle in the 1950s. There's a long hiatus into the 1960s. The ATMs were invented in the late 1960s. They were first rolled out really around 1972. And up until then, there wasn't a lot. And then after that, there wasn't a lot either. So there was a hiatus again, and banks were seen to be laggards. Other elements of the financial services sector have been innovative in different ways, so that we see innovation in the insurance industry, which we actually don't notice very much, but it follows a different cycle from the banks. And then we see, of course, this blossoming of innovation in trading, in stocks and bonds trading and other asset trading in the late 1990s, prompted by financial engineering, which was also a contributing factor to extreme instability in stock markets and had its own contribution to the financial crisis of 2007, 2008. So that was a very corrosive form of innovation. So the point is very well taken. The reason that I'm interested in looking at these kinds of programs and their designs in detail is precisely because it allows us to address what's really happening rather than just repeating the hype. And I hope that my presentation has demonstrated that, and that you can draw conclusions both about policymakers and regulators, which is the focus of this particular work, but holds implications for the commercial sector also.
There was another question about the data security and data privacy, and I believe we touched on this a couple of times in the questions and in the presentation itself. There is a very interesting comment from Dr. Ali Aouni. He was saying, I would like to get your views on the issue of fintech and financial inclusiveness. In the UK, 20% of the population are excluded by mainstream banks and lenders who use traditional credit scores to assess creditworthiness. In the US, the picture is the same. 7% no bank account, another 20% have bank accounts but are excluded from many banking services. The main issue in most developed countries for financial inclusiveness is the creditworthiness and not the cost of availability of the service, which is enhanced by fintech. In developing countries, issues are more around informality, which forms a big percentage of the economy, and the digital divide, where tools are not available to the majority of the population due to the ease of use, in addition to availability of internet or smartphones. And the issue here is systemic and is about the economic exclusion of a major percentage of the population. You would like to take your views on this?
Yes.
It's a very interesting point from a development perspective as well.
Yes, yes, absolutely. And I have a doctoral student who recently finished, who was focusing very much on this. She has extensive experience in a number of places in Africa and did detailed analysis of these issues about fintech's use of technology and financial inclusiveness. So I'll give her an advertisement here, but the core of this is not what we expect the business to do. The core of this is what we expect our policy makers to facilitate and how we create a condition whereby they enhance the opportunities for particular solutions to the problems of financial exclusion. I also think that it is an advantage to bring as much into the formal economy and out of the informal economy. To do that requires a great deal of trust in the tax authorities and in government more generally. And people need to resolve that problem. It's an institutional problem that needs to be resolved as these technologies unroll at the same time. And so I see them as paired problems, one an institutional trust problem, and the other a functionality problem. The fintechs, for the most part, are going to address financial inclusiveness insofar as they can find niches where the incumbent financial services companies have not gone. And the reason they have not gone for the most part is because it's been too expensive for them to go there. That is, open up very large numbers of tiny bank accounts is just seen as too expensive. And the fintechs feel that they have ways of doing this more cheaply. That's the only reason why the fintechs are going into that business, as far as I can tell. And so the real solution, I think, has to come from the attitude that we broadly share of mistrust of the formal economy. And that mistrust, I think, is unfortunate because it's expensive. It keeps people away from good financial services like debt financing and budgeting and the way in which services can be facilitated that expand people's opportunities. So I'm all for those kinds of things, but they're not going to pull the consumer base along.
Thank you very much, Professor Liebenau, for the very interesting presentation and the very interesting discussion. I believe we've addressed most of the questions. We tried to tackle them collectively. I would like to join the audience in actually thanking you for a very informative presentation on a very heated topic. Thank you all for the audience for being with us. We hope you really enjoyed it. And a couple of people were asking about the recordings. The recordings of the session will be shared with the registered participants. Thank you all so much, and have a good day.
It's been my pleasure. Thank you.
Thank you.